How debt and taxes can make smart entrepreneurs rich. Debt and taxes are two terms that make most Americans nervous and keep many others up at night. That's because most Americans, including those with six-figure salaries, lack fundamental financial skills such as how to use debt to earn money and how to legally and ethically avoid paying taxes. How can debt and taxes make some individuals rich while making others poor? Why is this contradiction present? The cause isn't the disparity between rich and poor earning potential, professional options, or social benefits. It's our country's lack of financial education. We don't educate kids about money in school. We tell them instead to achieve high grades so they can find a job and make money. We tell them to save money when they grow up and get a job. We advise them to save for the future by investing in 401k plans. No surprise so many people work their entire lives and cannot afford to retire without government assistance such as Social Security. Our lack of financial education results in a cash flow gap. On one side, there are employees and small business owners such as doctors and lawyers, as well as proprietors of startup businesses and local burger shops. People on that side of the split work for a living and pay between 40 and 60% of their income in taxes to the government. There are also large business entrepreneurs and the ultimate entrepreneurs, investors. People on this side seek to make money work for them. Employees and small business owners frequently claim that the wealthy do not pay their fair amount of taxes. They have no idea how the tax law works to keep the country running. When you work with the government to create jobs, provide homes, drill for oil, or supply food, things that the government cannot accomplish alone in a democracy and free market economy, the government grants you tax breaks. A lower tax rate is a major incentive for large business founders and professional investors. Learn how to leverage debt and cut taxes to become a wealthy entrepreneur. It's as easy as that. I'll leave you with some sound advice. 1. Get tax breaks on interest payments. The amount paid in interest on a line of credit, term loan, or any other sort of debt is tax deductible. Owners can deduct interest payments as costs throughout the tax year if they use the object of their loan for operations of their business, according to the International Revenue Service. According to the tax rules, all small enterprises are eligible for an interest payment deduction. Charges levied by the lender to finance a loan can also be deducted from the company's tax liability. Maximum loan costs, premium charges, origination fees, and other fees are all tax deductible. Consult an accountant to learn about eligibility for tax advantages. 2. Use debt to save money. Smart entrepreneurs are successful because they understand how to save money. Instead of depending on costly bad debts such as cash advances and credit cards, they take out low-interest loans. Long-term loans can also help to reduce reliance on high-interest debt. Making 5 to 6 financial advances in a row is detrimental to the business. It can only lead to an impossible-to-break debt cycle. Look for financial solutions with low interest rates, cheap monthly payments, and extended durations. You will avoid falling into a financial trap this way. 3. Select low interest rates. Debt taxes have the potential to reduce actual interest rates. When considering alternative financial solutions, keep the tax benefits of debt in mind and adjust the interest rate accordingly. A loan, for example, may have a 14% interest rate. This is available through just the right financing. If your corporate tax rate is 25%, your after-tax rate will be 10.5%. The formula is to remove the tax rate from 1 and multiply the result by the loan rate. So, 1 minus 25% times 14% equals 10.5%. This is the essence of how to leverage debt. As you can see, taxes can assist lower your interest rates. This has a significant impact on your company's bottom line. 4. Understanding your risks and options. Investing in every market has some degree of risk. There is always the possibility of losing money, regardless of industry. You may become a wealthy entrepreneur in no time if you grasp your alternatives. You should also explore turning what you would consider liabilities, such as loans and taxes, into profit-generating instruments. In other words, learn to use debt and taxes to your advantage. Well, that's all I got for you today. Thanks for watching.